In April, the President of the United States will walk into Beijing for the first time since his return to office. Donald Trump will sit across from Xi Jinping, and somewhere on the table, between soybeans and semiconductors, between Taiwan and tariffs, sits a decision that could either collapse the silver market or ignite its next leg to $200. On January 1st, 2026, China reclassified silver as a strategic material and activated a licensing regime that effectively placed a government gatekeeper between Chinese silver and every manufacturer, refiner, and investor outside its borders. Only 44 companies in the entire country are authorized to export. The restrictions are set to run through the end of 2027, and they landed on a market already in its sixth consecutive year of supply deficit. The consequences were immediate. Silver exploded from $80 to $121 in less than 4 weeks. Then it crashed 31% in a single day. Today, it sits at 77, a new low for 2026, down 36% from the January peak. The gold to silver ratio has surged to multi-decade extremes, and the entire precious metals world is now waiting for one meeting in April to determine what comes next. Here's the problem with that narrative. It is dangerously incomplete. The market is pricing silver as though the April summit is a binary event. Either the export ban lifts and silver craters, or it holds and silver recovers. But the architecture underneath this trade is far more complex than a single meeting can resolve. China did not restrict silver exports as a negotiating tactic. It built a strategic resource control system, one that mirrors its rare earth playbook from the last decade, and the infrastructure behind that system is designed to outlast any single trade deal. This is the story of what happens when the world's most critical industrial metal becomes a geopolitical weapon, and what Trump can and cannot negotiate in April, and why the two scenarios everyone is debating, ban lifted versus ban stays, both miss the structural reality that is already reshaping the silver market from the ground up. To understand what is actually at stake in Beijing, we need to trace how China built its silver choke point, not in weeks, but over decades. China's dominance over silver did not begin with the January 2026 export restrictions. It began with refining infrastructure. Over the past 2 decades, while Western nations outsourced their industrial supply chains, China quietly built the world's largest silver processing complex. Mines in Mexico, Peru, and Australia dig the ore out of the ground. But the metal that goes into solar panels, circuit boards, electric vehicles, and medical instruments overwhelmingly passes through Chinese refineries before reaching global markets. By 2025, China controlled an estimated 60 to 70% of globally traded refined silver. Not mined silver, refined silver, the finished product that industries actually use. This distinction matters enormously. Mining and refining are different choke points. You can open a new mine if you have the geological deposits, the permits, the capital, and the 5 to 10 years it takes to reach production. But replicating China's refining capacity would require billions in investment and years of construction in an industry where margins are thin and regulatory barriers are high. The rare earth precedent is instructive. China used the exact same playbook: dominate processing, allow the world to become dependent, then introduce export controls when geopolitical leverage is needed. When China restricted rare earth exports in 2010, it took Western nations over a decade to begin building alternative supply chains, and those chains are still not fully operational. If the pattern behind this resource control strategy is becoming clear, and you are seeing the blueprint that connects rare earths to silver, hit like and subscribe. Because what comes next reveals why the April summit may matter far less than everyone assumes. The December 2025 announcement from China's Ministry of Commerce made the architecture explicit. Silver was elevated from an ordinary commodity to a state-traded strategic material. Exporters must now produce at least 80 tons annually and maintain $30 million in credit lines. The licensing regime does not ban exports outright. It creates administrative friction, bureaucratic delay, and government discretion over every shipment. Licenses can take 45 days or longer to process. Shipments can be slowed, reduced, or redirected at Beijing's discretion. This is not a negotiating position. This is infrastructure. The 44 approved exporters, the licensing framework, the Ministry of Commerce oversight, all of it was built to function as a permanent control mechanism, not a temporary bargaining chip. And it mirrors controls already in place for tungsten and antimony, 2 other metals where China dominates global supply. So when Trump sits down in Beijing in April, the question is not simply whether China will lift the silver restrictions. The question is whether China would dismantle a strategic asset that gives it leverage over the world as solar industry, electronics manufacturing, defense supply chains, and monetary metals market, all in exchange for soybeans. The October 2025 meeting between Trump and Xi in South Korea produced what both sides called a breakthrough. Tariffs were rolled back. China agreed to buy 25 million tons of American soybeans annually. Export controls on rare earths, gallium, germanium, and graphite were suspended for 1 year. The trade truce was set to stabilize markets heading into 2026, and it did for rare earths. But 6 weeks after that handshake, China announced the silver export licensing regime. The timing was not accidental. Beijing gave Washington concessions on rare earths, minerals where alternative supply chains were already being developed, where the political pressure was loudest, and where a temporary suspension cost China relatively little strategic ground. Simultaneously, it tightened control over silver, antimony, and tungsten, materials where Chinese dominance is even more concentrated, and where Western alternatives are virtually non-existent. The pattern is what analysts call strategic substitution. Concede on the battleground your opponent is focused on, then advance on the one they have not yet fortified. The South China Morning Post reported on February 12th that both sides are now in active communication about extending the current trade truce for up to 1 year when Trump visits in April. China has confirmed Xi Jinping personally renewed the invitation during their most recent phone call. Treasury Secretary Scott Bessent has predicted up to 4 bilateral summit meetings throughout 2026. The diplomatic machinery is fully engaged. But diplomatic momentum and structural concessions are fundamentally different things. Consider what China would actually need to give up to meaningfully loosen silver export controls. It would mean surrendering oversight of 60 to 70% of globally traded refined silver, supply that feeds its own solar panel manufacturing, which consumed over 25% of global silver production in 2024 and grew again in 2025. It would mean relinquishing leverage over a metal the United States itself classified as a critical mineral in November 2025. It would mean dismantling a control framework that was designed to operate through 2027 and that mirrors Beijing's broader resource sovereignty strategy. The trade deal framework from October tells us exactly how China negotiates. It suspends controls. It does not eliminate them. The rare earth suspension is set to expire in November 2026. The export control relaxations came with review clauses. Everything China offered was temporary, reversible, and structured to preserve the underlying infrastructure of control. Even if silver appears on the April agenda, any concession would almost certainly follow the same template. A suspension with an expiration date, not a permanent dismantling. And here's the detail that most analysts are overlooking entirely. Even a temporary lifting of export controls would not solve the physical supply problem. Global silver demand has exceeded mine production for 6 straight years. The deficit is structural, driven by solar, AI hardware, electric vehicles, and electronics, and it exists independently of Chinese export policy. Removing the licensing regime would increase available supply on the margin, but it would not close a gap estimated at 160 to 200 million ounces per year. The market is not short because of China's policy. China's policy made an existing shortage visible. So here is what the market is not pricing in. There are not 2 scenarios for silver after April. There are 4. And only one of them is bearish. Scenario 1, the restrictions are fully lifted. This is what silver bears are banking on. If China removes the licensing regime entirely, the immediate supply overhang returns. Silver could test the $65 to $70 range as the geopolitical premium unwinds. But based on every precedent in U.S.-China trade negotiations over the past 3 years, from rare earths to semiconductors to agricultural products, a full permanent removal has a probability approaching 0. China does not give away strategic leverage. It rents it. Scenario 2, a temporary suspension modeled on the rare earth template. This is the most probable outcome if silver makes the agenda at all. China suspends the licensing requirement for 6 to 12 months. Silver dips on the headline, perhaps to the low 70s. But the market quickly recognizes that the suspension is reversible, the infrastructure remains intact, and the underlying deficit persists. Prices stabilize and begin recovering within weeks, as the structural supply gap reasserts itself. Scenario 3, silver is not on the agenda. This is more likely than most investors realize. The April summit has a crowded plate. Iran, Taiwan, soybeans, Boeing aircraft orders, energy purchases, rare earth renewals, port fees, and the broader trade truce extension. Silver export controls were announced after the October trade deal, not as part of it. They sit in a different regulatory category from the rare earth concessions. And no public reporting from CNBC, the South China Morning Post, or any official diplomatic readout has indicated that silver is a priority agenda item. If it is absent, the current supply constraint continues and the market begins pricing in the full 2027 timeline. Scenario 4, China uses silver as a new bargaining chip, offering partial concessions in exchange for something Washington has not yet put on the table. This is the scenario that carries the highest upside for silver prices. If Beijing signals willingness to negotiate but demands something substantial in return, say tariff relief on Chinese electric vehicles or a delay in semiconductor export controls, it confirms silver as status as a geopolitical asset on par with rare earths. That repricing alone could push silver back above 90. There's a question at the center of this that reshapes how you evaluate every headline between now and April. Is silver being traded as a commodity, or is it being held as a weapon? Drop your read in the comments, because the answer to that question determines whether $77 is a floor or a ceiling, and the sharpest macro analysis on this channel consistently comes from this community. The market today is priced for scenario 1, full relief, which is the least probable outcome. That asymmetry is where the opportunity sits for anyone paying attention to structure rather than headlines. Step back from the April summit and look at the map. Silver sits at $77, a price that implies the crisis is over, the speculative excess has been flushed, and normal market conditions are returning. But nothing about the silver market's structural position has returned to normal. China controls 60 to 70% of refined silver exports and has built a state-managed licensing system designed to operate through 2027. Only 44 companies in a nation of over 1 billion people are authorized to ship silver across its borders. The global supply deficit is entering its 6th consecutive year with no mining expansion capable of closing the gap before 2028 at the earliest. Industrial demand from solar, AI, and electronics is growing faster than any substitution effort can offset. And COMEX vault inventories have declined over 75% since 2021, with registered silver now below the 100 million ounce threshold. The April summit will generate headlines. If silver appears in a joint statement, markets will react in hours. Traders will rush to price in whatever concession, real or symbolic, emerges from the diplomatic theater. But the infrastructure underneath the trade does not change with a press conference. China's refining dominance took decades to build. Its licensing regime was designed for a 2-year operational window. The 44 approved exporters are not going to be expanded to 400 because of one meeting. And the global deficit that existed before China's restrictions will continue after them, regardless of the diplomatic outcome. What we are watching is not a trade negotiation. It is a structural realignment in how the world's most versatile industrial metal is controlled, distributed, and priced. The old system, where silver flowed freely through London and New York paper markets, priced by futures contracts with 300-to-1 leverage, is fracturing. Shanghai is trading at persistent premiums over Western benchmarks. Physical lease rates remain at levels that signal genuine scarcity. Industrial consumers are stockpiling because they no longer trust the paper market to guarantee delivery. The question everyone is asking, will Trump get China to lift the silver ban, is the wrong question. The right question is, in a world where the second largest economy has permanently elevated silver to strategic material status, where industrial demand is structurally inelastic, and where 6 years of deficits have drained global inventories to generational lows, does it matter? Remember the opening. One meeting in April, 2 presidents, and a metal that sits at the intersection of energy transition, monetary policy, and great power competition. The market is betting that diplomacy can resolve what geology and industrial physics have made permanent. Silver at $77 is not pricing in a commodity, it is pricing in hope. Hope that the structural deficit will close, hope that China will relinquish control, hope that paper markets can keep functioning without the physical metal to back them. Hope is not an investment thesis, structure is. And the structure, as of today, points in one direction. The silver choke point was not built to be temporary. It was built to be leveraged. What happens in April is theater. What happened on January 1st was architecture. And architecture outlasts every summit, every handshake, and every headline.